up traders, what up investors, Ken here from Dyslexic Investor, and thank you for tuning into a fantastic video. Today, we're going to talk about value investing. Oh no, Ken, he's gone to the dark side. He's talking about value. Hold up, don't just run away quite yet. I wanted to show you this pretty interesting site that I found on this thing that they call it the Buffett indicator, not the buffet indicator, which I would greatly appreciate if someone could make that, but this is the Warren Buffett indicator. Of course, Warren Buffett, the king of value and compounding investing, he didn't create this, but it's a very very interesting thing to kind of look at. So what we're just going to diving into, we're going to be really looking at, is the market currently overvalued? The Buffett indicator is clearly saying it is strongly overvalued. So what does that mean? Does that mean the market's going to crash? It's going to sell off? What's going on? What does that mean? So let's kind of just jump into the Buffett indicator as well. So the Buffett indicator is the ratio of the total stock market in the United States evaluation to GDP. So gross domestic product. If you're not familiar with that, that's how much we're able to produce from what we make here in the United States. As of the 25th of March, again, they usually update it on a Friday. I refreshed it a couple times. This is actually the 3rd of April. The market, I guess, the aggressive U.S. market valued at 48.6 trillion, and the current quarter is around 21.7 trillion. So we're nearly double-ish, or more of a double on the Buffett indicator of 223%. That's very, very high. And they kind of put this in graph form here. You can kind of see here. So what do they mean by GDP? So normally how people isolate certain things on a bear market and a bull market and kind of different components. A bear market is normally when you have 2 quarters of negative GDP growth. So that's usually considered a larger bear market, but we haven't really seen negative GDP growth for some time. Of course, that 08, 09, and 2010, we really saw some the overall market getting hit. In this case, we're currently seeing here, historically, this is a very interesting time due to the pandemic and really on how much money is being spent to stop the market from going into negative GDP and just kind of keeping things afloat to the best possible skew on a lot of people's mindsets. The team on this site make a pretty good point here. They're saying like, hey, it's currently at 79%, or it's about 2.58 deviations. So if you're not familiar with deviations, we're pretty overvalued on this particular chart. So I'm not saying the whole market's overvalued. There's some sections that I really do believe is overvalued. Historically, this is at all-time highs. However, with interest rates at historical lows again, but those are starting to kind of come up as well. They're potentially going to be Jerome Powell saying that he's not going to raise them until 2023, which we'll see about that. I would put a bet that's going to be sooner, but that's just my opinion. I think we might hear something early as maybe raising in 2022, but that's just my opinion. Is there a reason? This is the reason why they suspect that this time is different, and it may hold true. So they're not just saying, hey, holy moly guacamole, sell everything because the market's going to crash. That doesn't mean that. That's, again, because they highlight the internet bubble, which was the height was at 67%, and we're at 79%. This is due to the very large run-up that we've seen in the stock market of last year and really making in a very aggressive V-shaped recovery here. So looking at this here, this is some interesting graphs. I want to link this link down below in the description as well, so you can kind of check that out on understanding the Buffett indicator, the GDP growth, and basically looking at these historical trends here we've seen here. So we can go to different other indicators. So I wanted to actually talk and make another separate video about Ray Dalio, if you're not familiar with that individual, on his viewpoint on the market, which is also quite interesting. He's somewhat a value guy, but it's something very interesting to see here as well. So you can kind of see here the inverse. So this is the Buffett indicator, which is the blue here again, but then you see also the treasury bond rates. So of course, what we see here is the bond rates at the time of the bubble. So this is where they're saying this is the different time of like, hey, the historically the 10-year note at 6%. So again, this is the thing that you hear every person on CNBC and any other person talking about, like, who didn't know what the yield curve was, and everyone's like, what's the 10-year? I didn't even know there was a 5-year or 2 or 3-year yield curve. Yes, there's multiple yield curves, and each country has their own yield curve as well. So it's very important data to look at. Again, it's something that's somewhat nuanced to a lot of new investors because, again, this is a lot of new people have gone into the market. So this is basically what the breakdown is. It's like okay, the yield curves are so low right now. Normally, the average yield curve, which is average, that's pretty high, 6%. Okay, like not many. You can't buy very much, especially if you're trying to invest in houses and things like that, at a very high rate like that with interest rates. So looking at this potentially to look for this, so this is the deviation or what they're saying this is different. So, or this may hold true due to the fact of this is a different scenario. This is a different deck of cards. This is a different play here looking for. I've probably said different about 13 times now. But so if we do get a jump up from the 2, or the yield to get breaking above 2, which again, we've seen the yield run up quite a bit here in the last 2 months here, basically going from very flat to next to nothing due to the Fed really kind of keeping it suppressed. But now it's starting to rise up because the bond market doesn't believe that it's going to can maintain and stay this low. So you're seeing it kind of run up here quite a bit here. So we'll see on how this one overall carries out here. But this is a large important fact. So I don't think we're going to see the 10-year note by 6% of any time soon, by years, because if it jumps from 2% to 6% overnight, you better just, there's going to be a lot more problems than that. This is normally takes months and years to grind here as well. So you can kind of see here that hyper inflation that we really saw, not hyperinflation, but a lot of inflation that was creeping in when your parents, your grandparents, or whoever else were telling you like, hey, it used to be 16%. So if you're trying to buy a house with rates at 16%, holy moly, how are you able to afford that? Like, that's insane. So that's why you don't see much growth when the rates are so high. So you can clearly see when rates are lower, that growth really takes off. And of course, we're seeing historically low rates, basically from since 08, 09, that 10-year note has been continuously going down. And I think this might be the inverse, and we might start seeing these start coming back up to 6% because, again, we have not seen these low prices since this has been tracking since the 60s. So be mindful about that. So let's go ahead and jump into some charts here to kind of break down of what we could be looking at. So we're just going to be looking here initially right on SPY, which is the SPY. Why am I doing this today? Because guess what? We closed at 400 at all-time highs for the S&P 500 and the SPY. Closing at gapping up on Easter weekend here. Again, we had the markets closed due to the observation of Good Friday, breaking to an all-time high, really rocketed ship higher. We really need to go into a longer term chart here. So we're going to be jumping into the monthly chart. So 1 month, each ticker here is 1 month, and this goes back all the way to 1994. This is what I think this is the max. Yeah, this is the max that the Thinkorswim platform allows me to do. And what do you kind of see here? Like it's quite interesting here to kind of see, like the S&P 500 was only $155 in the 2000 bubble, and then came down, basically traced about 45%. Then we had that run up into the 08-09 crisis, and that basically just got back down to where it was on that bubble here, on the run up into the internet bubble. But ever since then, so this is when the lower rates took place, and really just saw the yields on that come down year over year, and that's what has made this market go substantially higher. And this is why you see a lot of people within the Discord. If you haven't joined already, greatly appreciate it. Come on by and let's talk. Where people were discussing, I'm like, hey, that this can't be sustained, but they've been saying that for the last decade, and Is there going to be a time when the it's going to be the piper is going to be calling for us, aka the yields are going to start going higher, and then investing is going to be a little bit more difficult. It's going to be a lot of money is going to be transitioning back into the yields, more of a standard for the government to back up money and continuous growth on that end. Maybe I can't predict the future, but you have to be ready for all these kind of scenarios. But with this here, we're seeing tremendous amount of growth coming from the S&P 500, even though we're seeing the yields slowly go back up. At the same time, the NASDAQ, let's just go to the QQQ to make things a little bit more simple. And of course, this thing has been a pure rocket ship. This has not closed at all-time highs, but it was pretty close, and that was in the month of February. So it closed around 300 and let's just call it 338, 340 nearly at all-time highs, and it's kind of making its way back up here. This thing has been extremely aggressively moves higher. So some things that I kind of do sometimes is I like to do what the percentage move from the 34. Okay, hold on, let me zoom in here real fast. So what we're gonna do, we're gonna go right here, and what was the percentage move from here? So that's about, from the 34 EMA, it's about an 85% move from that, the main deviation here at the all-time high. So let me see over here on what we can see. Let me make sure I line up the line, and we're seeing 50. So in relatively pricing, again, that was the most simplest. So don't criticize me there, Joe. I'm looking at you on the sense of that very basic analysis of just the on the chart basis on how much has it been relatively strength from this 34 EMA, because that you can see here, that's the 34 EMA is what I like kind of use, or the 21 EMA as well. But on the longer trend, I like to see the 34 EMA. You can kind of see here, this has been a pretty strong flagship of resilience on market down move. So we're seeing it being basically hit in that low that we saw in 2020, that market sell-off basically in 18 in December, and then the same time around the 15th-ish, in the middle of 15 is where we kind of saw that really strong market volatility come in, when we did see some things kind of change on growth, because you can't really see that when that's the first time it really kind of came into play, when people are like, I don't know how, if this is when the higher yields were coming to play, and it was very much a flat year from 15 into like the middle of 17. We saw really not next to much growth overall. You can really see here on the NASDAQ side, it was very flat. And this is actually when I started to get into option, was like mid of 14. And when most people get into options, they are just buying calls and puts, and it was a insane time to try to I wish I knew premium investing when I first started. This would have been a fantastic year for that, but ever since then here, that has just been a rocket ship higher. And again, maybe are we in for a more of a trading sideways year? Maybe, we'll see. I think that we still have a lot of growth to see and how it goes. And another chart we want to look at before I let you go, and I really appreciate everyone sticking around, is the IWM. So this is the Russell 2000. So this is again an interesting one as well, because this is one that has been very choppy here, and this is the one that potentially could see the largest investment with all the stimulus going through. We're seeing, of course, not everyone's taking their paycheck or their stimulus check, whatever it is, $600 or $1,100, $1,200, $1,400, and just buying a new iPad or a computer or going to Disney World or whatever. But the large amount of stimulus that we're seeing being pumped into the market, I'm not the market, but imagine, never mind, you understand the metaphor. And then just seeing it to be moved higher with the potentially larger infrastructure bill. Of course, that's going to make short-term jobs or temporary jobs on roads and whatever things they want to do, and really start investing in EVs and making America a more robust country again. We do have crippling stuff again. We don't have to go down the stats on education, other various things, but we potentially could see this run up quite a bit, because again, by what I mean by that is it's already run up quite a bit here. Just from that short-term bottom here, we're seeing that really rocket ship higher and potentially could stall here for a little bit. But again, this is going to be very difficult to see on how this continues to play out. I'm a little bit more bullish on it as well. I have been very bullish on it, but taking a little bit of profits on the table and just kind of seeing how things happen, really in tune with the yield curve. So being very mindful about that and looking at that, not on a daily basis at least, and seeing how that plays out. But on that note, ladies and gentlemen, I want to thank everyone for stopping by and watching the video. Greatly appreciate it if you check out the links down below. We have the affiliate link for Audible, which you know I love listening to audiobooks. Always do it while walking, having in the car, while I'm sitting in my chair back here doing research, all kinds of fun stuff. And if you want to be getting into creating a fantastic account, investing, trading, cryptos, whatever, Tastyworks is an affiliate link down below. If you open an account of $2,000 or more, you have an options of selecting 10 call options or 100 shares of a stock that's usually, it's reasonably priced between like $7 to $20. I've seen some people get some pretty interesting stuff. But I think the value stays under 750, so it kind of fall into that range there. But on that note, guys, ladies, thank you so much for stopping by. Please hit the like and subscribe on the way out the door, and I'll catch you guys on the flip side. Peace.